Hello and welcome everyone to the weekly Delphian meeting. Thank you for tuning in. So today's agenda, we'll go through the market update and then Joe's going to do a little Q&A after that. Now just apologies last week for Ashok not being able to come. We'll try and get them in the future as the schedule allows. Just looking out the next few weeks. So next week, I'm planning on getting the results from the studies, the quarterly report. So hopefully I'll have that ready for next week's meeting. And then, the 15th, let me pull up the calendar here. So that'll be next week. And then the week after that will be earnings release. So Q2 2022. That'll be our earnings release. We'll put out the plan on the 15th. So that's the plan for the next couple of weeks here. All right. Any questions on that? All right. Let's get started. All right. So overall market, you can see indices, we're all still in 8, even after those decent moves up last week. VIX did drop to 2. I did want to show something about VIX here in a little bit. Green pie, so that's increased significantly. We're above 30%. So we all know, well, at least I've repeated it a bunch, under 30 is oversold on the market. So we've been oversold for a long time. So we're peeking our head right above that 30. We'll see if that holds. Not looking like it today. But it's definitely, had a decent move. So we'll get into that. So let's look at market pulse. So I pulled up the bullish bearish first here. Sorry, I have children in the background here today. So you can see that, last week, we were at 1738, got up to 31.6 as of yesterday. Probably won't hold based off of what's going on right now. But basically, that 30 over time has, let me draw a line here. So this 30 has been a pretty good marker for, when things are at a bottom. So, this time it went well through there and, we're dipping above that. So I would say, and that's at 25, but sorry. But at 30, that's typically the range, and this is probably 30 here, right about here. So once we get above that range, if we can hold above 30, that kind of area, that's a really good thing. If we can hold above 30. If we don't, if we drop back down there, then obviously, that's some issues overall for the market. But, that 30% is kind of a critical level that we've looked at back over time. So that's something to look for, kind of watching this on a daily basis. And you don't even have to come into here to look at it. You just, get the screenshot here on the initial page. But, this gives you a lot better layout over time of how things have done. So, if it stays above 30, obviously that's a bullish sign if you can hold above that 30. So, we have one day above it. We went from 27 to 30. So we're technically, as of yesterday, we're not oversold anymore. So we'll see how that plays out in the future. The lows have, gone down significantly. And we've seen this quite a bit in the past where, we get spikes and then, you can see the lows drop down to 87 down here. The highs barely peaked above it, but, you're just not getting any kind of good high number since November. So, until we can start getting some kind of pop-ups on the new highs, I would say um, things are continuing to look the same. We get some rallies when these things drop. What I did want to kind of pull up, so like if we look at this like year to date, and if we pull up like a VIX chart year to date, so if you can just kind of see, it pretty much mirrors, the peaks and valleys here. So, I don't track VIX a lot, but this kind of mimics it with, seems like a lot more detail and kind of a quicker reaction than the VIX overall. But, if you pull it out to like a year, you can see kind of same type of chart, just little spikes, and then you start getting bigger and bigger. And this kind of mirrors pretty closely what I see in the VIX, which is why I don't follow the VIX much, but I kind of like this, this a lot more, granular view, because you get the highs and the lows versus that VIX. So, VIX still elevated, above that 25. Historically, since that COVID, had a lot of problems getting below that 20, finally kind of dropped below there, but, we're well above that 20 still. So everything's still elevated, because historically back here, going back, we're down in the low teens. So we never really got, low teens, but now we're still really elevated, which, helps define what's risk in the market. So obviously still some more risk out there, even though this went into state two, but it actually did a pretty good run in state one for a while. So what to see if that turns back into a one again. That would be bearish. If we talk about in general like stocks that go in, like SPX, very bullish stocks or indices, they're doing 1, 2, 1, 2, 1, 2. So if VIX ever starts doing 1, 2, 1, 2, that's really bearish for the market, because that's like a counter trend to where things will move. Any questions so far on that? Before I close out VIX, I got so many things open. So, all right. So, yeah, I mean, I didn't get much from state one, state eight. Let me load this up. Obviously, same kind of action with the, nice drop off on the eights, but still extremely elevated. You'd like look for the continued effort for things to, really in the next few days, just look at the lows, because we got a decent down day right now. And then that, I wouldn't look at this too much, but the overall bullish bearish, can that stay above 30? If, once that's kind of like an all clear, if it can stay above that 30 for, a few days. So let's move into SPX. So you can see, outside of the Fed day is had a pretty typical pattern, hit the average down here on this day, ramped way up and ran right into resistance. Let me draw a line here on the entry price level 41.55. Our key levels obviously are going to be, down here on target 3, and then, in this range also 1 and 3, and then, support, or I guess resistance to the top side is going to be up in the stop loss range. So our typical pattern, is typically go down here, ramp up, go down here. So this is basically where it hit the average move. which is right at our 3,800 level. We've been talking a lot about that. So, from here, we'll have to wait and see. It's still in state 8, obviously the longer it's in 8, the more bearish I think you can get. So, we had a nice move up here, but ran into, resistance on our entry level at 41.55. So, 2 days basically tried. Let me clear this. So like you had 2 days here, tried to get above there and failed. Obviously, opened up higher today, but significantly down. So 7 real problems here. And, I would expect that to continue just based off of looking at the charts. So let's look at the chart for SPX. So you can see down, our range that we've defined was 3,800 on the low end to 4,200 on the high end. So, got back here near, 3,810 and really popped off that. So, as we get up closer to here, what you can see, which I want to kind of annotate here, we have our 50-day and basically right on our 4,200 level. So not only do you have, this range that we're in, which I did, these 2 bars here, instead of trying to hand draw it, I put them in the chart. So these 2 are basically colliding, and I think I talked about this before. It'll start getting interesting once the 50-day is basically right around the support level. So that's where we're at right now. So you got the 50-day pretty much right on our 4,200 level. You can see 41.95, 93. So, as it continues lower, that's something definitely to watch for on the SPX. You can see we had, a breakout here, and then, like the retest failed on this 50-day. Here, it was pretty strong resistance. This is pretty much the closest we've got in a while, since it crossed back over. So that'd be something to watch too. But it's pretty much the same numbers right now that you can watch, that 4,200. So that's kind of the quick rundown. Still the same range, 42 to 3,800 on SPX. So let's get into the Russell. So Russell, I told you guys last week, kind of watch that lower level, if you can get below that T3. Obviously, things just ran up. So, we're kind of in the middle of the green box here. Not too much to surmise. You can see our kind of key levels annotated in this range, 1,900, 1,700. So, we, as of yesterday, we're near the upper end of that. Still expect to stay kind of in that range for time being. Let's look at the chart for Russell. Same thing. It's always a good thing when things line up. You can see the 50-day pretty much right on our upper range of 1,900. So same thing SPX is going through. It did test around that 1,700, but this run up, this nice run up, 3-day run up, pretty much failed right at top of our range. So doesn't look like it's going to break through in the near term. I did been talking a lot about, June's going to be interesting, and we just started June today. So so let's talk more about that. Sudhir sent a timely chart for us here. Well, thank you, Sudhir. So what this does, it's looking at, 4 key indices in the world, Euro Stock 50, S&P, MSCI World, and the FTSE. So, and the frequency of markets rising each month. So, this time period from 87 to 18. So good data set, 30, 31 years. So basically, this tells you how often, over that 31-year period.
Está en mute, está pasando una conferencia de inversiones.
I got it. Okay. How often, percentage-wise, that month is an up month. So you can see, here's June, force track record. So 36.7% of the time over that 31-year period, June is an up month. And you can see in general, the worst 3 months are, June, August, September. Then your best month here is December, or they put Santa, but December is usually pretty strong, and then April's the other one. So very interesting. I wouldn't expect it to be that significant, but obviously June is pretty bad. So it should be sell in June, right? And I guess that's why they say sell in May, but interesting data. I don't know if Sudhir, if you had any other comments on that, but thanks for sending that. I can, I'll put that in the chat so people can have that reference also.
Yeah, I did have, I just found it interesting how seasonal it is, and how bad June is in general. I just found I like Visual Capitalist. It's an interesting website, and they send out these cool graphics and stuff. And so they did this, the study was, like you said, 31 years and 4 different indexes. And, so it was really, I thought, insightful. So just your odds of having a good June is the worst, worst month of the year.
Yeah.
So, and we're already going into Fed tightening, quantitative tightening and interest rate raises, and then you have the seasonality factor, which the graphic says, people tend to go on vacation, so there isn't as much money in the market and stuff like that.
Yeah.
So it's just, and today is a big down day. So there is a chance that June is up 36%, but it's not great given all the conditions going on right now.
Yeah. Well, I mean, just odds wise, I mean, everyone else is a coin toss or better, pretty much, 50% or better, except for 1 month, which is kind of an anomaly, pretty strange, especially over that time period, So it's got to be something to it. I don't know if I buy all the, their explanations for it, but, I don't know. But yeah, definitely very interesting. So wanted to share that with anyone. I mean, everyone, not anyone. There was another article I pulled up. So S&P suspends forecasts as higher rates slam brakes on the global bond market, right? So S&P, the company, we track S&P 500. They're a rating agency, they have indices, things like that, a bunch of other business. So, but they warned of an extraordinarily weak bond market and basically suspended their full year forecast. I thought it's very important to talk about this. No one's really talking about, debt when, debt is a key driver of this market. Every company, almost every company has, a lot of debt. Most people have a lot of debt. So, debt, we're a debt-based consumer economy, if that's how I would sum it up. So, as rates rise, the loans rise on houses, on cars, on your credit cards. So that's kind of why, I kind of key off of that 10-year to watch that real closely and gave you kind of the key levels. I think based off of history where things will turn ugly. But definitely a very interesting article to look through. What's the other one? Yeah, Eurozone has highest since their inception in 1999. And I haven't followed this, but they're still in negative interest rates over there. Like, that's absolutely crazy. If they're like, let's just say they have 7 or near us 8% inflation, and they're still negative rates. That's just crazy. So interesting. Consumer prices. So I'll also post this so you can have it real quick here. That was one article that really jumped out at me. I thought it was important to look. And that 10-year, I like to look at the 10-year. Been very volatile since year to date. We started the year 162, so we're at 293. Had good spike up, the past few days here, not near the 312, but closing in on getting above that 3 right now. On how things have really jumped up here, but very volatile. If you look over time, longer term, it's usually a pretty slow moving market, but we had that big drop off in COVID. We got down to like 0.56. That was almost 2 years ago. It was 0.56, and now we're up above, right around 3. And you can see the top here. The last time they raised rates, we topped out. It's like 322 something. So we haven't been above that since 2011. So, if we get above, these levels, it's going to get pretty crazy, I think, overall. But definitely keep your eye on that. I always said, that chart that I pulled up from a while ago, with the correlations in a rising rate environment, over 4, it starts getting ugly for stocks, historically. So, could it be sooner? For here, yes. All those other ones, I don't think they had 9 trillion in assets, but on the Fed balance sheet. So, could be a little lower than that, but just want to put out the research that we found here. So, pretty ugly day. Countdown tool. We got pretty much baked in, that's 2 weeks away. So earnings release and Fed day, who could ask for a more exciting day, 2 weeks from now. So 94%, if anything, it's creeping a little with possible higher than 50 point. Still think 50 is baked in next meeting. Same with, like July, it's just creeping a little higher. So from what we had previously, but minimum, it looks like next 2 meetings, 50 rate hike. So be real interesting what happens with our 10-year, over the next month or so. The other real big thing going on is no more QE. We're on the QT. Quantitative tightening. So, we talked about this a lot, and that's why we figured June was going to be very interesting. The article from S&P, quantitative tightening, this tells me that, at least for now, the easy money policies are going away. And that's not a good thing, I think, for the market overall. Macro wise. So, I think, as long as we continue on this course, it's not going to be good for equities, raising rates, dumping assets. My biggest thing is, okay, are we going to, at some point, we look at the past, the Fed would step in or reverse course. They did it with the last interest rate hiking cycle in 18. And they also reversed on, their last QT, quantitative tightening, where they just basically, we started seeing all that weird liquidity overnight issues with the bank, repo rate jumping like 10%. And then, they reverse course on that. So, that would, are they going to reverse course? I mean, in the near future, I don't think so. I think they're set, for the next few months. I would say, depending on how ugly things get, there could be something like that down the road. So, but until then, they seem set on continuing this, and just don't see much upside for the market. So
They didn't
that's
have inflation as bad in those, like the 18 cycle and all that. Inflation wasn't as bad like when they started tightening in 18 and that sort of thing, right? So that's really I don't think they can reverse course until inflation is resolved.
no, we had no inflation issues in 18. The whole talk was about normalizing rates, we want to normalize them to historically normal rates or whatever. That we had no inflation problem back then, or at least, based off of their readings. So, it's nothing like we have now. That's why they're in a bind. I mean, there's actual like huge inflation going on. Every time I go to the grocery store, something went up. Oreos went up $1. Over the last like week or something. For my kids. So there's always something going up. In the stores. So, and gas prices are unrelenting. It was weird because there's like one day where it went up like 50 cents, like overnight. And then, it's just creeped up slowly from there. I think, it's like 460 something here. But like it was $4 and then like the next day is like 450, like across town, every single gas station. Like, because I was driving all over, but every gas station had like the same price and it all went up 50 cents. I'm like, this is not normal. Normally they change prices when they get like a fuel loadout or whatever. So they all don't load out the same day, or fill up. So it was strange. Anyway, yeah, but there was definitely no inflation like this last time. I remember, they were talking about just normalizing the rates. And it's like a test run because they probably knew this was coming. So, they test out the raising rates and then they tested out, the quantitative tightening separately, but now they're doing it together. So both times.
My
there was
feeling on the
serious-
18 thing was Powell, when he came in, he was just against those low, right? I mean, from a philosophical, economic standpoint, right? And he wanted to normalize the rates just because that's his economic outlook, right?
Yeah.
And then when the market started to crash, he had to reverse course. This time, though, you have a huge inflation problem, the worst in 40 years.
Yeah.
The cost to fill up my tank has doubled, not doubled, 50%, right? It used to be around $40, now it's $60.
Yeah.
And, they have a mandate. Their mandate is full employment and stable prices. That's their job. So until we have full employment, but we don't have stable prices, and until they achieve stable prices, they have to do their job. They're going to have to raise the rates and they're going to have to tighten,
Yeah. Yeah. I mean, the best hope would be that, inflation like slows down. I mean, that would, for the economy, obviously, that this actually turns things around, but hard to say, with these meager moves.
Yeah.
So Well, thanks, Sadir. Good comments. Anyone else have questions or comments on the market? All right, well, I'll let Joe go just to reiterate, the ranges, SPX is 4,200 to 3,800 and then Russell 19 to 17. So, okay, Joe, you want to go?
Sure, Josh. Hi, everybody. Let's see, Josh.
You want me to
Can
pull
I
up
share?
anything? Oh, okay. Yeah.
Okay. Hope everybody's doing good and had a good holiday weekend. See, one thing I just wanted to ask, and Josh, as always, thanks for the good insights. Is anybody on the call bullish? Okay, and I really wanted to be, going back a couple of weeks ago because of those 5 waves down and the retracements, on the whole move from March of 20. And then we got, some of the, I guess it was the Dow, maybe the Russell, we had the 5 waves down. I think S&P, maybe we got 7 down, but then, we're trying to obviously hold those lows. Sadir talked about, I think for maybe the last 2 calls, the possibility of a 8 to 10% rally. And lo and behold, we got it, in the indexes. You go back to the 520 lows. Basically, we had that intraday low for the most part. I mean, I think RUT bottomed maybe a little bit early on the 12th of May, and then the rest of the indices pretty much intraday on Friday the 20th. And we maybe even closed up that day. But, we've had essentially between 9 and 11% rally off those lows. So, the conversation about going forward, as much as I want to be bullish, it's really hard given, what's coming up with the balance sheet for the Fed in June. So, a couple things I just wanted to pull up. And here is our dashboard. And it was maybe a month or 2 ago, probably closer to 2 months ago, when I mentioned that everything on the bond side, bottom right-hand corner, was in state 8. I noticed last week that, both the 1 to 3 year and the 7 to 10 year had come off of state 8, and I think it was the SHY, which is the 1 to 3 year, that had been state 8 for some crazy period of time, over 170 days. So this was last Friday when, these two were, in a mildly bullish state 7. Lo and behold, we come to, the markets after Tuesday's close, and, one of those 2 indices had moved right back to state 8. And, that kind of shocked me. I just, look at these charts periodically, but the thought that, one day we went from a bullish to a bearish, state, especially in the slower moving bond space, really surprised the heck out of me. So I went and looked at the charts. I'm just kind of thinking, as much as I want to be bull, what's the case I can make, on the bullish side? And that would be the bond market showing me something different. And so here, if we go to, this is the one ETF, they're both iShares. The IEF, I guess, is this 7 to 10 year. And let me see here. There it is. I mean, right-hand side, it went from state 7 to state 8, literally in one day. But you, on average, just 25 days, these moves. So anyway, that just, to me, was speaking about the volatility in the markets. It did strike me, though, as I went back and then looked at this, we had something similar happened in late February, early March, which really surprised me. and then early November. So because I wasn't that familiar, went back, took a look, and Ashok's algorithms are pretty consistent here. So for that state to change so rapidly was not that extraordinary. Here's the shorter term 1 to 3 year, and as I said, it went into its state 8 last September, and on average, I think this is similar as well, just 25 days. In state 7, it's only 11 days, but I think in this state 8, this thing, typically is also only 25 days. This box that, we put together a while back, I'm sure some of you look at it. I just love the references because, again, it's data going back to 2007, how many occurrences and average days are really, to me, important guidelines. But you can see this thing, was in a state 8 forever. And the fact that it moved into state 7, and I just want to keep an eye on it, as well as those other bond ETFs, to see if, possibly there's any change, in the direction for rates. And then just kind of reiterating what Josh said, the SPX, you got that, Sadir, I think it was about a 9% run. We got through that, 3/8 retracement on the way back up off of, the last leg down. We are not pretty close, but not quite to the 3/8 retracement. Josh was talking about that 4,200 level. You go back to the January 4 highs, that's where we come in on a 3/8 retracement as well. And, in a bear market, typically Elliott Wave, you're not getting, much beyond 3/8 or 50%. So both of those are holding pretty true to that. And, we see the violence with which the market turns. Russell, just that same perspective. The last leg down, we got a 3/8 retracement. I think, the Russell's the index I'm watching the closest, really. It led the markets, with topping out last November. And, that's the one you can see, just like the S&P, we got, a couple higher lows here, but whether they hold, only time will tell. And, there we are, still a long way to go. If you go back to the November highs and in the Russell to get up to that 3/8 retracement, which would be about 1990. So, another solid 100 points in the Russell. So there's just a couple of charts I wanted to just kind of point out, but especially, to have an eye on the bonds and see what they're doing with the states. Josh pointed out, we're up to it was 27 on Friday, and then almost all the way up to 32%, on the bullish pie on Tuesday's close. So that has moved an awful lot out of those extremely oversold lows, in the middle of May, I guess bottoming out May 20th. So any comments from anybody? Any talking points?
You think that the current bear market rally is over?
Good question, Sadir. Do I think it's over? No. Yeah, the speed of the down move, which is pretty typical. Well, it's actually been moving extraordinarily quickly in both directions. I don't really have a strong feeling for it, until we can break, and we got ABC patterns to the upside. You get the Russell below this 1750, 1800 level, I'd say for sure. But right now, I think it's kind of a wait and see. That's kind of where I am. Anybody have any favorite option strategies they're using at this point? I personally, like the vertical spreads, but just wondering if anybody else has any favorites that they're using.
Hey, Joe,
Go ahead.
How are
sorry.
you? Hey, Joe, how are you picking your stocks to put a bear trade on or anything that you like, even if,
Well, basically looking for some of those state eights that seem to be oversold. And was that Lee asking?
yes, I'm sorry.
Yeah.
Yeah.
No, that's fine. No problem. To be honest, I'm watching more than I'm trading now because we're super busy trying to get our house in order, both from a website and platform perspective. And so, I'm doing much more there than I am on the trading side, to be honest with you, Lee. I can't wait, to be more active on the trading side, but the priority at this point is to get, and I'm not the tech guy, but we have performance issues with the platform, and then, we're in the process of rebranding, so spending the vast majority of my time there.
Okay. Just a follow-on comment or two to what you were saying before, whether whether people feel bullish or bearish and what you think the market's going to do. And I look at the administration that we currently have, and I think things that are being done add to the inflation or add to the difficulties. And I don't see any interest in changing the direction that they're going. They believe they're right and they're taking steps in that direction. Now, with that, I'll also say the Fed, with their tightening now, and although I hear remarks about inflation is peaking, I'm very similar to Josh when he goes to the grocery store and he sees Oreos are up $1 from last week, but it's so many things. And I think inflation is still spiraling up, in my opinion. And I think all this leads towards a bear market, certainly for me, over the next few months. And everybody on the call knows more than I do, but that's just what I'm saying. I don't see reasons to feel positive about the market. So these are just random thoughts in reaction to what I thought I heard you all speaking about.
I appreciate it, Lee, and I assure you, I'm a numbers guy, and I go to the supermarket and I just get aggravated. I question whether or not those Oreos were for Josh or his kids.
Yeah.
But I mean, the numbers are striking, be it the supermarket or darn near anywhere else. I did just a little bit of homework, and, there are a lot of different sources out there, but just to get a sense for overall bear markets. And again, as much as I want to be bullish, because I'm an optimist by nature, as I think I may have mentioned when I first started, most floor traders are generally bearish traders. I tended not to be that way. I was a long gamut trader, but, kind of always wanted to be bullish. I went into just, some brief homework on bear markets, and there are lots of sources out there, but, a couple stats that I pulled out that speak to your point of an ongoing bear, Lee. Since 1928, depending on the source, I saw where there were either 26 or 28 bear markets since 1928. On average, and I'm not sure whether they were using the S&P or the Dow, but the average decline was 36%. We're nowhere near there at this point. And the average length of time was 289 days. So depending on whether you take last November or January, we're also nowhere near that as well. We're somewhere in the neighborhood, I guess, to 100 to 120 days in, depending on, what index. So, on that, the averages suggest that, we still got a long way to go.
Yeah,
Which is-
what I read
which
is,
is, go
is
ahead.
similar to what you're saying.
It's depressing, but hey, every bull market obviously needs a bear to clean itself out. And I think it was Sadir who mentioned, maybe on last week's call or the week before, we got so low on the green bar, in terms of, bullish states in our database. You would think you get, a bounce out of that, which we got. We got a meaningful, solid 10% bounce. And now, the more I talk, Sadir, the more I think that, yes, the bull market counter trend rally is over and we're heading back into the dumpster, but time will tell.
Yeah, so that kind of leads to, how to trade the market. And I've been leaning toward, although I haven't done many. Since you asked the question, what are people trading? I do trade the studies, but I do trade the credit spreads much further out of the money than the actual study recommendation, right? To give some room. And the other thing I've been looking at is bear call spreads. Because we've been in an uptrend for so long, I generally don't do them. And I find they don't test that well in the back tests because so much of the database is bullish, right? That you kind of have to test them almost manually for just certain periods of time, like late 2018 or something. But it seems like intuitively, I haven't quite figured out, but it seems like bear call spreads around away from the money around the standard deviation should work. Like, for example, you've mentioned we've had I forgot what you said, 8 to 10% run here. And so if you were to do a bear call spread right now on the Qs at the upper standard deviation, seems like that would have a high probability of winning, right? Because I just don't think it will keep going. Right? I don't see any reason why the Qs just would keep going up. What do you think?
I mentioned if I were trading more, I would be doing more of those vertical spreads. I mean, and that's, so we're talking, one of four, the bullish calls, bearish calls, bullish puts, bearish puts. But certainly, those call credit spreads, would seem to make a lot of sense in a bear market environment for sure. And to your point, and I think we've talked about this also before, obviously that strike price selection, there's nothing more important when you're talking options. What strike, what month?
Yeah, so that's kind of what I'm thinking, because as you mentioned, 280 some days, I don't see an end. I don't see an end until the Fed says, okay, we're done. We're going to go to the sidelines. Things are where we think they should be. We're going to not do anything more. Until they do that, I just don't see the downtrend stopping. We're going to see these 8 to 10% rallies, but I think they're just short-term rallies in my opinion. And it will eventually turn back down until the Fed says they're done.
Well, to the credit to the group. I mean, the gang's been talking, the bear side of the market for many, many months here. So, and obviously Josh as well. So appreciate the conversation. And Josh, expect to you.
Okay, thanks, Joe. Yeah, great comments, and everyone else, great conversation. So yeah, just watch those key levels. I don't think it'd be real tough for us to get above those upper levels of the channels right now, and what to see, if we retest those lows and what happens. So that's about it for this week. Does anyone have any questions or comments before we shut down? All right, well, we'll close it up. So next week, hopefully we'll have the studies ready to present and then week after that earnings. So thank you all and have a great day.
Thank
week,
you.
everybody.